Welcome to Lecture 5. We're going to be talking about funding and money for your medical science startup. We're going to learn about the importance of raising funds to support your enterprise. We'll also discuss the challenges between raising funds and in exchange, if you wish, for equity in your company. So essentially what you're doing is you're selling shares of your corporation in exchange for, of course, their money that you're going to use to support the scaling, the development, the research, the running, the operations of your startup. But we're also going to look at what's most important for your startup. So, yes, you need money to run it, but really the most important aspect of any for profit enterprise is to make money. And in order to make money, you need to generate revenue. And so that really should be the number one item on your to-do list is to generate revenue. But unfortunately, in the medical sciences, because of the nature of what we do, there's usually a much longer delay before you are what's called revenue positive, meaning that you're actually generating profits. And the reason for that is because of the work we do, right? In medicine, it's very highly regulated. And therefore, there's a very long path in terms of getting to a point where you can actually sell your product or sell your services. And for that reason, you have a much longer period of time where your startup is consuming dollars, right? Because you're paying employees, you're buying product from your suppliers in order to manufacture whatever you're making, and that costs money. And so the problem, of course, is, well, where do I get that money to be able to do this, to be ready to sell it and then start generating revenue? And so that's where we're going to discuss the idea of raising funds. So by encouraging investors to come in and give you money, so purchase shares in your company in order for you to use those funds to bridge the gap between until you're profitable as a company. And so that's very tricky, and that's what we're going to be talking about in this lecture. So why is funding so important if you're in the medical sciences with your first startup? Well, as you have heard, or you may have actually been part of, research and development in the medical sciences generally requires large sums of money in order to get through from bench to bedside, so to speak. And taking as an example the pharmaceutical industry, where you're part of drug development, once you have a product that you think is efficacious, you're going to need to test it. So generally you go through animal testing first, you do in vitro stuff, and then you do animal testing, and then you're at a point now where you're ready to test it in humans. And so you go through your classic phase 1 trial. Well, that's going to cost you about $4 million. Now these of course are just approximations. Your phase 2 will cost about 13 million, and your phase 3 will cost about 20 million. And that, I would say, that's like the low end, right? But once you put it all together, getting your product, especially in the pharmaceutical industry, ready to be sold commercially is going to cost you millions and millions and millions of dollars. Now, that's the pharmaceutical industry. Can you think of a startup, where you won't have such a large cost? Yes, absolutely. Even like a product in like a medical device. Yes, of course, if you're thinking an MRI machine or a CT, of course, it's going to be, once again, millions and millions and millions of dollars. But if you have a very small device, like a widget, so to speak, something that nursing will use, by the bedside to hold or pin something, or it's just a plastic widget. Well, because it's being used in the medical, environment, it may very well need to go through regulatory approval, and if if that's the case, then even though manufacturing it is going to be relatively cheap, the process of bringing it to the bedside is still going to be fairly expensive. It may not be anywhere near this cost of in drug development, but it's still going to cost you a fair amount of money. And so that's where people get a little surprised. And it makes sense though, because you're dealing with humans, of course, and you're dealing with caring for basically a vulnerable population. So anybody who is not feeling well, is ill, is pretty much a vulnerable population, and for that reason, you have to make sure that whatever treatment you're providing, or whatever medical device you're using is safe and efficacious. There's got to be a reason for you to use it. And so that costs money to validate that and to bring it to market, so to speak. So what are the other costs? Of course, running your company, there's the overhead of operations. There's manufacturing costs if you're manufacturing a product. Of course, marketing, because you have to be known. You may have a fantastic product, but if nobody knows about it, who's going to buy it, right? So marketing is very important, and protecting your product from competitors is also very important. So there's a cost associated with protecting your intellectual property, let's say through patents. That is, there's lawyer costs associated with that. And you're going to not only have to protect your patent in North America, but you'd also have to protect it in Europe. You'd have to protect it in Asia. So there's, those costs add up as well. So let's use as an example the swift development of the first COVID-19 vaccines by companies such as Pfizer or Moderna. Now, they required billions of dollars to bring these vaccines to market. And this is an example of the importance of funding in order to make it happen, and fast, right? As it was in the case of COVID-19. It was literally a race, right, to getting the first vaccine. Now, who provides this kind of funding in the medical sciences? Well, in our world, I mean, you'd hope it's like something simple, like, well, why don't I ask mom or dad, or I'm going to ask my brother or my sister, or I have a really good friend who, I think he's rich or she's rich, and maybe I'll ask them to lend me some money. Well, believe it or not, that is actually one source of funding, and it's called family and friends. No joke. And a lot of companies actually stay at that level. So meaning that they incorporate and they split, so they have shares, right? So they have shares that they can sell, and they sell them to family and friends, and that's sufficient. So they're not self-funded. Self-funded would mean that you use your own money. But if you start selling shares to family and friends, and you keep it a private, private equity, a private company, then that's one way of doing it. Unfortunately, unless you're really lucky and you have extremely rich friends, the chances are, for a medical sciences company that with a medical device or with a drug development, it's just not going to be enough money. And so generally the next, level would be what's called angel investors. And they're usually, very affluent or, wealthy individuals, and they have capital to provide startups, and they generally in the earlier stages of startups, what's called a seed or early phase. And they'll lend money, and they'll not lend money, sorry. They will invest their money, up to certain amounts, and it's all relative, right? Some angels may invest millions, but generally angels are going to be investing less than that, not large sums like that. And they're willing to take a larger risk. So they're taking they realize they're taking a bigger risk because they're investing at a very early stage. And so they do this because they have the money to spend. They have to spend the money, maybe from a previous successful exit of a company or something like that, or they're just personally wealthy, or they win the 649 or something. They just have a lot of money. Then they will do this because this is for them. It's a means of investment, right? And they're obviously very comfortable with very high risk investments. beyond that is going to be called the venture capitalists, and they are professional investors, and they can be part of a company themselves. They can be part of a group, and they are going to invest in your company with large amounts of capital, but in return they're going to take a larger chunk of the ownership of your company, which you need to be aware of. So that's where you need to decide, who am I going to deal with? Generally, it goes from family and friends, or self-funded family and friends, angels, and venture capitalists. That's usually the order. And I'm going to say, if you're in a smaller company that's a consumer product, let's say, then you may be able to get away with like self-funded and family and friends for sure. In the medical sciences, you tend to need to move or progress to venture capital fairly quickly in order to survive as a startup. It's not always the case, but very often. So let's talk a little bit more about venture capital. It's essentially a form of equity for early young stage companies, so startups. It tends to be early stage as opposed to just starting. So there is a difference. And venture capital is not going to jump in unless you've established yourself with a good value proposition. You have a business plan in place. You're incorporated. You have some evidence that what you're working on is valid and is possible. But venture capital comes with investors who will believe that your company has potential. That's what they're looking for, but don't forget, they're professionals. They're looking to make money, right? So they want to invest in your company because they realize there's a very good chance that your company is going to turn a profit. So meaning that it's going to increase in value from the time that they purchase shares, right? So they purchase shares at a much lower price early on in your the growth of your company, and then when your company exits and you sell the shares, you go IPO or something fantastic like that, the shares are going to be worth a lot more money, and then they make a lot of money. So they're professionals. That's what they're looking for. Now, this type of capital is crucial for what tends to be high risk, high reward projects in the medical sciences, right? And venture capital provides more than capital. So what comes with it is generally, so most of the time, strategic advice, networking opportunities, mentorship. So when you bring on a venture capitalist, that's what you're going to get with it. And you're going to say, oh, well, that's so nice of them. But not at all. I mean, sure, it is nice of them, but they're doing it because what they're doing is they're safeguarding their own investment, right? So that you are an investment for them. So what they want to do is, when they buy equity, so they purchase shares in your company, they're also going to want to be actively involved because they want success. They want you to be successful. So they're going to give you mentorship. They're going to give a great network that they come with. They're going to give you strategic advice. Is it always a good thing? No, unfortunately, not always. Some venture capitalists can be somewhat meddling in your affairs, and you may not be happy with what what they're trying to do with your company. And that's always the biggest risk, is that you're going to onboard a venture capitalist that's going to force you to do things that you don't want to do. They may, even, have a large enough share in the company that they can cause problems for you in terms of, who's directorship of the company and stuff like that. So you do need to be careful. And we're going to talk a lot about that later on in the course. But, just also think, if you're bringing on venture capitalists, they're not going to want to hang around for 25 years. Right? They want to make money in their lifetime, right? So think that, they're going to jump in where companies are projected, to be successful, if you wish, within the next, 3 to 7 years is probably a good number. They maybe stretch it out to 10 years, but they're looking for something to turn around within 3 to 7 years. So keep that in mind as well when you're going to venture capital. All right, so what if you're thinking about that? Oh, this venture capital thing, it's a big deal. I'm not sure if I'm really ready for, giving up a large portion of my equity. I'm really early in the process. There's a lot of risk still. What can I do to get some money? So I'd mentioned earlier angel investors, and that's definitely a valid option as well in the world of medical sciences. But they tend to be high net worth individuals who are investing their own personal funds, right? So what comes with angel investors is flavors, right? So you have angels that they have a particular, um, you know, interest, right? They have their own interests and preferences. So they're going to invest in you because they believe in what you're doing. So either they're really into the tech that you're developing, or they're really into the treatment that you're working with. They have a personal connection to, let's say, the disease that you're addressing. So let's say something like Alzheimer's or something like that. They've unfortunately their grandmother or their grandfather died from early onset Alzheimer's, and it left a real impression on them. And so then and they have a lot of money, so they've decided, I'm going to invest in that. So is that a good thing? Yes, of course. It's great. You have someone who's driven, who's motivated, and who has drank the Kool-Aid just like you. So that's wonderful. Um, it's a little different because it's personal. It's also someone who's taking a very high risk with their money as well. And so how do you choose between the two? Generally, the choice is made for you, and that is angels will only go to a certain value in terms of how much they're willing to invest, and venture capitalists always tend to be, that next step, that next level that they're going to, invest more. So if, let's say, your venture capitalist and your angel is offering the same investment, right? And you're like, okay, well, who do I go with, right? What do I do? Well, generally, angels are not going to come with networks, mentorship, strategy. They're not going to want to be on the board, right, of directors, right? They don't want to be on the board of directors of your company, and so they tend to be just, here's the money. I'm taking a big risk in you. I really hope you do well, right? And it. I'm not going to say it stops there. I mean, they're still going to stay in touch and stuff like that. But that's what you're getting money from them. Venture capital, you're getting, as I said, generally you get more with it. So you're more advanced in your corporation, but also what you're looking for is strategy. You're looking for networking. When you bring on a venture capitalist, maybe you want them because they've worked in the industry before, and you know that the contacts they have and the people they've worked with is who you need in order to reach out and collaborate or work with them or whatever. So that's generally the difference between the two. Some angels come with some networking as well, and some contacts and stuff like that. So obviously there's a little bit of a muddying between the two, but generally that's what you're looking for. And I'm going to say in the medical industry, VCs tend to be more prominent in terms of supporting investing in companies that are in our space. Tends to be more VCs. But once again, I'm going to say it again. If you're doing a drug or a major, medical device, absolutely, that's where you're going to end up. But if you're doing a small widget, you're doing a small little intervention, a small little something like, I don't know, let's say, linen, linen for, in hospital beds. I'm totally making this up. But let's say you have this fantastic idea about a good way of producing a linen that's going to wash well and it's going to be, have antibacterial properties and all that kind of stuff. And it's cheap and, whatever. You may get away with something a little bit smaller, right? You don't necessarily need a VC on board, where you need millions and millions and millions and millions and millions of dollars to do this. Then yeah, it's an option. So definitely keep them both in mind. And I would, once again, I would probably think of just going from family of friends to angels to VCs and just follow that progression. All right, let's start talking about some of the what would be considered the new funky ways of raising funds. And so one of them is equity crowdfunding. So this is like a more modern lifeline that connects startups like you with a crowd of investors. It's basically democratizing the investment process, by selling small equity pieces to a very large group, right? So instead of, finding one VC capitalist that's going to give you, $10 million, you're gonna do the opposite, right? You're gonna ask like 10 million people, right, to give you $1 each, right? So is it possible to use this? Absolutely, especially for medical startups because crowdfunding, people need to believe in it, right? So it's got to be something that they're willing to invest in, just a small amount of money. You just need a lot of people that are going to believe in it. So just think, if you to convince one venture capitalist of how amazing your product is and the impact, that's like taking them out to dinner and having a seat with them, showing them your slide deck, talking, multiple meetings, and then boom, they say, yep, you know what, I want to invest. But just think, if you're going to get, thousands of people to invest a very small amount. That's a lot of work, right? And in order to do that, it's got to be something obvious. It's got to be something that they're going to be willing to get behind quickly and just say, yeah, sure, why not? What's $100? I'm in. I'm gonna do that. And so that's when it tends to work. The equity crowdfunding. Um, there's the example of there are a few examples, right, of equity crowdfunding platforms that have been put in place, and they can, you know, basically fund stages. Even it doesn't even have to be necessarily the company itself, but it could be to fund a specific piece of your research and development progress, right? So it can be stages that, like for instance here, Bioneer was able to proceed to stage 2 clinical trial due to equity crowdfunding, where they raised, in this case, example, 1.3 million euros, right, to do this. So there's just an example. There was another one, Helix's successful funding through Cedars, right, which furthered their AI-driven drug discovery for rare diseases. So there's another example where they were successful in this equity crowdfunding space. Now let's talk about something that I think most of us are fairly accustomed to or acquainted with, and that's grants. So just like in research, grants are available to help accelerate startups as well. And they are non-repayable funds, from government bodies or agencies that support research and development in startups. So it's basically to promote innovation. And the reason they do it, and we've talked about this before, is because startups represent a very important component of our economy because it employs many people. It purchases from suppliers in order to manufacture whatever their product is, and so they uh, are vital essentially to our economy. And so the government realizes that and supports them by providing granting to energize, infuse, money into these startups. So there are many examples, of course, as you know. There's the classic CIHR and NIH, CIHR in Canada, NIH in the US. You have to be careful there that those grants are not going to be awarded directly to a startup. But if your startup is collaborative or working with foundational research in the academic setting, then that money can benefit the startup as well because it's paying for research and development. And that's okay. But then there are funds that are specifically for startups. So Life Sciences Innovation Fund, Canada Biomedical Research Fund. So there's some funds that are directly supportive of the startup companies, and there are many other funds available. And there's also indirect funds to startups, and that's through the accelerator, or what's called the RICs, the Regional Innovation Centers. So those are basically government agencies that have received money from the government in order to support you, and they can award you with these smaller funds like in the 15, 20, 30, 40, $50,000 range, that they're going to give you this money to help you along, and they're nurturing you in their accelerator, center or whatever. And that's another way of supporting you through would be considered grants. So let's say you're successful of going through family and friends, angels, some early VC, and now you need an even bigger chunk of money because you've got an order or two or three or four. So you have these big orders that have come in because you've been successful, and you need a lot of money in order to put this order together, right? So let's say you manufacture a medical device. You need to create all of these medical devices to fill your orders, and for that you need money, right? Because you have to have the manufacturing process in place. You have to hire all the people to do it. You have to pay all your suppliers, right? And then shipping and all that fun stuff. So it's a lot of money, and that's maybe too much for an individual investor to provide for you. Now you're looking for 10, 50, 100 million, right? A lot of money. So what do you do? So generally then you start to go into what is called series funding, and it goes from A, B, C, D, E, F, G, etc. It tends to be in the A, B, C, D, E ish, is the more, and each series is a chunk of funding, that's VC funding, that you're going to receive. Sometimes it can be multiple VCs that come together to put this funding together. And there's always a lead VC who's going to take the charge, right, and do the due diligence with you. And then there's going to be tag along VCs that are going to say, oh, that sounds great. Yeah, okay, I'll put some money in that as well. And then that fills your series. So your Series A is your first big series funding or raise. It's called a raise. And it's kind of steps, if you wish, that's taking you closer and closer for you to become a revenue positive, successful company, which generally the goal at that point is going to be, going to IPO, right? Initial public offering. So you're going to go on the stock exchange and sell your shares publicly. That's generally what series is taking you towards. This is, I would consider, late stage startup. So you're bordering on a scale up. Or maybe you already are a scale up. So for the course that I'm teaching now, this is not where I'm focusing. I'm focusing on you starting. So I'm focusing on even like self-funding. Like you have your own money and you're just gonna get started. How do I get started? What do I do? What's the idea and all that? That's what we're teaching in this course. Maybe this course would take you to the stage of an angel investor. That's probably about it. Maybe VC, maybe, but that would be it. All the series and all that stuff after that is later stages, and it's great to think of, it's great to know of, but that's much later. And it's basically you dealing with success. The problems that come with success is what that's what you need the money for in series funding, is that you are successful, you do have a product, there is a solid value proposition, you have a company that's working, and you now need the money in order to fulfill the growth of this massive fast growth of your company. You need money to do that, and that's what the series funding is for. But be careful, once again, every time you put out a raise for money, you're exchanging that money for equity. So that means that your portion of what you own in the company is getting smaller and smaller and smaller. So for an example, when we're talking about our series funding, a Series C funding, so you've gone through A and B, and as I said, A and B are your first ones. C, generally, you're a mature startup and you're looking for a transition to what would be called a mid-sized company. So that's really big, in my opinion. That's big. And the Series C, when you get into Series C, it tends to be something as big as a hedge fund or a bank that's going to be leading this raise for you. So that really is like way beyond the scope of this course, just to give you an example. So why the series based funding? It's basically because it's steps. It's allowing valuations of your company at each stage to decide whether or not funding should continue. So instead of, just doing some big massive one-time raise, you're kind of raising money as you need it. And the reason for that as well is because, unfortunately, what happens, as I said, is that you're going to lose equity in your company. So meaning you started by owning 100% of your company, and then as time went on and you took on more and more investors, you're now slowly losing control of your company, essentially. And that's a very delicate trade-off in terms of how much money do I really need to get going here, and how much equity am I willing to give up in my company. And so that's why these series-based funding steps, if you wish, are important for you to kind of to stop and check and go, okay, where am I at on this, and am I doing the right thing? And that's the intent of it. Let's talk a little bit about equity dilution. So if you start a company yourself, you own 100% of the equity. Let's say you bring on a partner, or let's say you started the company with a partner, then you both own 50% of the equity. Now, as you bring on more and more funders or investors, you are sharing pieces of that equity with those investors. So the company value increases with funding, but your individual stake in the company will decrease. So it's that delicate balance that if you own less of the company, but the company is worth more, then ultimately that's advantageous to everyone. Does that mean that it wouldn't be better for you to own all of the company? Yes, of course. And then you will own all of the profits. However, if you don't bring on funding at the right time, you may actually fail as a company, and therefore you end up with absolutely nothing. Or no, that's not true. You still own 100% of the equity, but that equity is worth nothing. So that's the decision you need to make, which is always tricky, but necessary in most cases. If you need the money in order to progress and be more successful, then it's worth bringing on investors. It's just that you need to be careful how much equity you give away, and in the end, was it worth it? So meaning that, could you have done it on your own, for instance, but it would take longer? That's always a difficult decision, because sometimes you bring on investors because you want to make it happen faster. You want it to happen now. You want it to be successful quicker. So you're bringing on investors for that, purpose. But that may not always be advantageous. It may not always pay off for you. Maybe if you retain more of your equity, you bring on less investors, but it takes you longer to get to market and to be successful. Well, that's okay. And so that's something that you need to strategize. And this is where you would talk to mentors and, seek advice as to what's the best path forward. So the next question we have to answer is, how do we get this funding? Well, the simple answer is you ask for it. But of course, it comes down to when do you ask, how do you ask, and who do you ask for this funding that is going to make the difference for your startup. As we've discussed, all startups need funding to operate, need money to operate, and funding is one way of getting that money that you need. So inevitably, it is part of the startup culture that you need to be aware of, and you need to know how to navigate investors. And so, as we discussed as well, investors can be family and friends, it can be angels, it can be venture capitalists. And they're all different, and the way you pitch to them is different. Inevitably, if you ask your sister or your brother for money, it's going to be probably an easy ask, right? You're very comfortable with them. They probably already know about what you're doing. They're probably already very excited for you, and so asking them for money may not be that difficult. But as opposed to going up, and trying to convince a venture capitalist to give up $10 million is very different and generally a lot more difficult. And that's what we're going to talk about next. So you're interested in taking on some investors, whether it be family and friends, angels, VCs, crowdfunding, no matter what, you are going to have to perform a startup pitch. Generally, these are done, or very often these are done at pitch competitions. That's a nice way of getting started into this world of pitching. But you can also be invited to pitch sessions, which are for a room full of investors, for instance. These are very often organized through accelerator centers, your RICs, your incubators, because that's one of their, I guess, it's a form of service that they provide their startups is to put them in front of investors who are looking for opportunities. So all of these investors are going to want to know why you need the money. So your startup pitch is going to be a brief presentation to possible stakeholders to showcase your business plan and your vision. And most importantly, it's also going to show return on investment. So meaning what kind of return do the investors hope to obtain by investing in your company? Because remember, this is not a room full of philanthropists who are looking to donate their money. It's a room full of investors, and usually very smart investors, who are looking to turn a profit. So basically interest on the money that they invest in your company. So you need to share with them not only, of course, the idea, because as I said, especially for angels, they're going to be investing in things that they believe in or that they personally are interested in. So that's kind of, it's important, of course, because that's kind of the first step of inviting them into a world that they're interested in. And then, of course, they're going to think, well, can I, make some money when I invest in this startup? So that's what your pitch is going to provide. So what are the components of a pitch? I mean, obviously after the first introduction, hello, my name is, and I'm the co-founder or founder of, and you give the name of your startup, you're going to immediately want to get into, what's the problem you're addressing, right? So, what are you trying to solve? Right? And then immediately that's going to, move into your value proposition. So what are you providing as a solution, right? So here's the problem. Here's the solution we're either working on or developing or we have developed. And then what's the value proposition, as we've mentioned in previous lectures? What are you providing that's of value to the stakeholders that are seated in front of you? And as you know, there are more than just the stakeholders in front of you who are typically investors, but you're going to have very important stakeholders who are your clients, your customers, right? Where's your market, right? So like what market are you addressing? And that's going to be the first part of your pitch. You're then going to move probably very quickly into your business model, right? Because as I said, first introduce the problem and solution, right? And that is going to attract a certain investor because that's the area of interest that they have for investment. And then you're going to, give your value proposition, which is, telling basically the investor, oh, I get it. This is what is of value to the client, customer, or stakeholder that is going to, make the sale, if you wish, right? So the transaction, why would there be a transaction of money? And then right away, you have to talk about the business model because that's where the investment comes in. So for the investor to say, well, I want equity in that startup, they have to understand your business model. So what are the revenue streams? Like where and how are you going to generate money? Is it going to be monthly? Is it going to be yearly? Is it on contract, on one big contracts that you make, or is it going to be monthly recurring revenue because it's a service, let's say you're providing, or sale of product, which is an easy one, right? So those are the revenue streams. You're going to look at, you're going to have to provide the idea of pricing because they're going to, the investors are going to, in their head, they're going to look at, oh, I see that margin. Wow, that's a fantastic margin. And yeah, I believe we are going to make money, or they're going to listen to your pricing and they'll say, nah, I don't think that's going to work. And it's not a big enough margin for me to feel comfortable investing in the company. Your financial projections will be in there very quickly. You're just going to say over the next year, 2 years, 3 years, 4, 5 years, this is how we're going to ramp up. This is how the revenue is going to, increase as we, enter into the market and we broaden our address of the market, or we penetrate the market, deeper. That's going to be your financial projections. Then you, of course, with financial projections are going to be your milestones. After 1 year, we're going to be here. 5 years, we're going to be there. Once you get all that, then you fully have their attention. So they see what you're doing, what the solution is. They agree with you on the solution and the value proposition. They see the money. They say, wow, those projections are fantastic. The value of your company is going to increase, over the next 5 years. So I want, an investment now to benefit, in those projections. Next, they say, are you the person to do it? Are you and your team capable of doing what you've just stated? So that's when you have to present your team. Who are you? Who holds what role? Where's the expertise? Who's going to do what? So then that provides credibility to your ability to fulfill what you've just pitched, right? Once they believe in your team, then they're going to want to know, if I give you money, what are you going to do with the money? So how will the investment be used, right? Because not only do they want to obviously benefit from, their investment, but they also kind of want to know what you're doing with the money. So if you were to invest the money and then you go out and you buy a car, you give all of your executive a huge bonus so that they can go out and buy a car. Well, as an investor, that's not what you wanted, right? So you want your investment dollars to go towards the growth of the company. And so that's why they want to ask you clearly, what are you going to do with the money, right? And then lastly, what's very important is, what's the exit strategy? Because what happens with private equity is you don't make money until you sell, right? Until you exit. So you either have to sell the company or you have to go, IPO. So it means you're going to be a publicly traded company. And those are the two main exits that you need to consider. And those are the ones that the investors are going to want to hear, because if you say in your pitch, oh, I can't wait to build this company, and then I'm going to run it forevermore, and we're going to run it as private equity forevermore, and we have no plans on exiting. Well, as an investor who's looking at a 3 to 7 year turnaround, let's say if you're a VC, that's not what you want to hear, right? Because you want to be able to have the opportunity to get your money back, right? And so if the company just keeps running, and if they say, well, don't worry, we're going to be so amazing, we're going to share profits through dividends to our shareholders. Certainly, that's an option. But that's not necessarily, and very often not, what investors are looking for. They're looking for a full exit, what's called liquidity, right? So that their investment is going to come back to them as money, as cash. So keep that in mind when you're doing your pitch. All of this has to be short, to the point, and very, very clear. And then lots of time for questions afterwards. So let's touch a little bit more on this investment strategy. Investors want to know, how you're going to be using their money. And so you want to break down, exact costs and uses for the funding, because it helps the investors, you know, understand what your intentions are and consider whether or not they agree and they're on board with it. Because if you don't share it with them, then they're going to have to make it up for themselves in their head. They're going to say, well, I suspect they're going to be doing this and this and this. And it leaves room for them to wiggle out of wanting to invest. And you don't want to do that. You always want to make sure that your goals are clear and align with whatever you're doing with your company. This, of course, is also going to be tied to your financial projections. Because the money that they give you is only going to last so long, and they're going to want to know what your plans are for afterwards. Obviously there might be more raises, but very important, you're going to want to tell them immediately whether or not you're going to be able to stop relying on investment and moving towards revenue, right? Getting revenue into the company. That's what they're going to be very happy to hear about. So what do you do in order to prepare for your pitch? Well, first you're going to want to know how long is your pitch, right? So is it a 1 minute, a 5 minute, a 10 minute, a 20 minute? You have an hour. Generally you're looking at about a 5 minute pitch. Like most often it's 5 minutes with some questions afterwards. You can have some pitches which are really short, 1 to 3 minutes, but generally you're looking at a 5 minute pitch. If you have time and it's pretty relaxed and you have more time to present because they're already interested, let's say, in your company, then you might be looking at a 10-minute pitch with questions or something like that. It's rare that it's going to be any time longer. 15 minutes would probably be the longest pitch that I've ever come across. But generally 3 to 15 minutes. Now, obviously know your audience. So who's listening? And do some research, right? So if there are investors, look into what's online about your investors. Who have they invested in the past? How much have they invested in the past? What sectors? What reasons have they invested? What kind of turnaround have they looked for? If you can get that information, because if you can then tailor your pitch to satisfy, what those investors are interested in or like to hear, or the dollar amounts and all that stuff, it's going to be very helpful, right? Now, of course, tell a story. So you are a storyteller, and you definitely want to craft a very clear and convincing story, right? So generally it means technical knowledge is going to be at a very high level, right? The most important thing is what's the problem, what's the solution, where are you going to be looking to implement, right? Your jurisdiction, and which determines the market. So that's what you're going to want to be looking for. Even if you've for the last 15 years you've been working on this unbelievably amazing technological advancement, keep it very high level. Generally, investors are not at your level when it comes to technological, like technology and science. They're most probably not going to be at your level. That's not always true, but in general it is, and you can't go wrong if you keep it simple and clear, and then during questions you can answer anything at any level. The next, of course, we say it all the time, is visual, visual, visual. So do more visualizations, more graphical figure representations, pictures than text. It's easier because you got to imagine if it's just you pitching, then fine. But generally you've got like maybe 5 or 10 companies that are all pitching in a row. And for the investors, wow, that's a lot to take in, right? So the easier you give them, it is easier for you to give them something that they can remember visually, right? And as they always say, a picture is worth 1,000 words. And in this case, it really is. So try and throw in as many as possible. Don't make your slides crowded, but make them, very visual. And then, of course, the short and sweet. So yeah, absolutely. If you can do shorter, do shorter. Because what happens then is you just get more questions, and that's fine. Nothing wrong with that, because then you can tailor whatever you need to respond in those questions, as opposed to if you make a very long and compressed and fast presentation, then often you will lose people. So the next step is a problem you want to have, and that is managing your investors, right? So let's say you do get investors. Can you just take the money and say, okay, thanks, ciao? No. You must maintain that relationship with your investors, right? You must communicate with them, especially if they become shareholders. You're going to be communicating with your shareholders all the time anyway. But investors, even if they invest in your company, let's say you're lucky, and they invest in your company and do not purchase equity. So let's say they do a debt investment, for instance. So in that case, they're going to be quote unquote loaning you money, and that loan is at a very high risk for them. So it's not like a bank where it's guaranteed and you get a certain percentage, and they get a certain percentage on that because you're paying it. But a debt investment means that they're investing in you, but then you have to pay them back the money, and you have to pay them back a certain amount of interest at a certain cadence and all that fun stuff. But it is all dependent on the success of your company. So meaning that if you go bankrupt, well, if you just don't make it, then they realize that that's a risk they took, and so they don't get their money back. So anyway, regardless, you're going to have to manage your relationship with your investors. Always be very transparent with them. Always. I'm not saying, to the point where you have to give them a minute by minute update on the company. No, but you certainly cannot hide things from them, because they are deserving of understanding where you are as a company, because they're vested in your company. So that would include, regular financial reporting, of course. Also working with them to provide expectations and timelines of what's the cadence they want to receive. Some investors are going to say, you know what, just tell me when I get a lot of money, right? I mean, that's pretty rare, but it can happen where they're going to invest in you and just say, hey, you know what, you do you, and you tell me when you exit and I make money. It could be, but generally they want more than that. And then if you're thinking of changing strategy, or you're making change, anytime you make changes that are impactful to the company, you need to share that with your investors. So remember, it's not just take the money and run. You're inviting them onto the team. Essentially, you have to include them as team members. Now, as I said, they're not open to everything that happens internally in the company. No, they are considered external. So that means that you treat them that way, but you have to keep them in the loop, and you have to be transparent with them. So let's touch a little bit on financial basics for startups. This is really going to be very high level. You could do an entire course on the finances for your company, for your startup. In this one, we're just going to touch on the basics to kind of get you started. So most important are going to be your financial statements. Now, when you start your company, you're probably going to do everything yourself on spreadsheets and all that kind of stuff. But once you start getting money in and out of the company, so let's say revenue, if you're lucky, you got some revenue coming in, early revenue, or you take on investors, or no matter what, you're going to have, in and out of money. And if that's the case, you're going to be dealing with a bank, of course, and you're probably, and I suggest you, build a relationship with an accountant, right? So there are many accounting firms out there that are willing to help you, and they are actually very generous with startups. So definitely, look for that. You can do that through your accelerator group or your RIC. They are usually partnered with accounting firms, and you can find the perfect fit for you. It's definitely Goldilocks. Some people want very little involvement with their accountant, and some people want their accountants to do everything. So you definitely find what fits for you. And once your accountant is in place, then they are going to help you, or of course you can do it on your own. Provide these statements. So the first one is the balance sheet, which just shows your assets, your liabilities, and equity at certain points of time, right? And that's your balance sheet. Your income statement is, of course, a great statement to have, because it means you have revenue. And in there, you're going to look at your revenue and your expenses, and this is what's going to show you a profit or a loss over time. So you're going to want your income statement. Cash flow statement is definitely more of a operations statement or report, and it's your accountant is definitely going to be helping you with that one, and that's to track the movement of money, cash, in and out of your company. And maintaining cash flow is very important, because you don't want to at some point be short on money and you can't pay for something. Oops, that's a big problem. And interestingly, you may be super successful, lots of revenue coming in and sales and everything's wonderful, but if you don't pay attention to your cash flow, so meaning that you have your salaries that are going out every month, and you have to pay your suppliers, and you have to pay your taxes and all that fun stuff, and then you're just thinking, oh, I got all these contracts, they're all signed and everything's wonderful, but then you don't pay attention to how your clients are paying you. So are they paying you up front? Are they paying half? Are they paying a deposit? Are they only paying when you deliver, and all that? And oops, you don't realize that at one point in time you're going to be short $50,000 because of the timing of the money coming in and the money going out. Well, what do you do if you're short $50,000? Well, that's a huge problem. So you definitely want to keep an eye on your cash flow and project it, right, to make sure that you always have the money you need to operate your business, because if you run out of money, that's a huge problem. Now, the last one is the statement of changes in equity, and this will be to display the changes in your company's equity within a period. So that means if you're selling shares, if you're providing shares, right? Are you splitting shares? There's a whole bunch of there's different components of equity that you're going to have to keep track of, and then you're going to produce this statement over time. All right, so in the last slide, we talked about this challenge with your cash flow and that you didn't want to be caught, with, missing money to make a payment at some point in time because you didn't plan correctly the ins and outs of your money. So very closely related to this for startups in particular is what's called the burn rate. And that's just simply the money you spend on a monthly basis. How much money is going out the door of your company every month? And you're thinking, well, who cares, right? Like, whatever. Is that important? Yes, it is. And the reason for that is because you're a startup and you may be pre-revenue, right? So you may not be earning money. So there's no money coming in the door other than investments. So investors, when they give you $1 million, say, here you go, $1 million, go. That $1 million lands in your bank account and you're like, wow, fantastic. And right away you say, okay, all this money here, we're buying stuff from suppliers to manufacture. All of this money here is going to paying salaries on a monthly basis, et cetera, et cetera. Well, you can imagine that money, because it's fixed, it's only $1 million, you're every month you're going to be losing a portion of that $1 million, and that's your burn rate. So how much is going out the door, to operate your company? But there's nothing coming in the door, so that's the problem, and so that's your burn rate. And the higher your burn rate, the faster you're going to run out of money. And when you run out of money, that's called bankruptcy. If you owe money, obviously, if you run out of money, you don't owe anything, then you're not bankrupt. But if you run out of money and you owe people money, you're bankrupt. Your startup's done. So you want to keep an eye on your burn rate, and you want to lower your burn rate as much as possible, right? And the reason for that is, of course, you don't want to run out of money. But this burn rate also provides you an estimate of how long the company can operate before needing more funding, before you need to ask for more money from an investor or investors, or before you need to put your company on hold, right? That's another possibility, especially if you're a services company. You can just go and kind of, reduce your staff and then go on hold for a little bit and wait till things improve or until you land the clients you want. But if you're the classic, startup that has investors, well, your burn rate determines when's the next raise. When do you next need to take on more investors and dilute everybody, which, everyone wants to avoid. So that's important. And so now you're thinking, well, does everybody have a problem with burn rate? Or when do you lose that, need to monitor your burn rate? Well, you do when you're profitable. Because once you're profitable, you're actually, giving back to investors, let's say in dividends, you're sharing profits. So it's profit sharing. So if you're constantly sharing profits, well, you're not super concerned about your burn rate because you're always making more money than you're spending, right? So then the burn rate is no longer relevant. And that's, once you're established and you're a big company, Microsoft or whatever, you're not worried about your burn rate. And so that's why it's very, typical for a startup to pay attention, but then once you're established, generally you don't, right? So how can you manage your burn rate? Once again, it's cash flow, right? So look at that. Where's your money being spent? And then obviously plan your revenue coming in and your expenses. So try and plan, how your revenue is going to come in. You can ask your clients, you can say, hey, can you please, it's a big project and you're, I just landed a $500,000 project. Yay, fantastic. That's $500,000 in the door. But if you can't pay your developers to work on it today, well, you're going to have to ask for that money in tranches. So, please give it to me in $100,000 tranches, the first one right now, and then we have milestones, and all that helps you with your cash flow. And that's how you get through it. So the other thing we need to keep an eye on is the return on investment, especially on behalf of your investors. And it's essentially the measure of profitability of an investment relative to its costs. What's the net return divided by your cost of investment? So you want to compare return on investment between different options, different investment possibilities to choose which one to pursue. So this means as a company as well. So not only is it your investors that are going to be very mindful of their return on investment on your startup, but for you as a startup, you are going to be investing in various vehicles, um, continuously throughout the growth of your company. So, for example, on equipment, for instance, what's the return on investment of purchasing equipment or farming it out, to a contractor or something like that, somebody who already has that equipment. So that's something that you're going to look at the different options and see which one is a better return on your investment over a specific, period of time, right? And obviously, a higher return on investment will indicate a better, profitable investment for you. But in the medical sciences, return on investment is tricky, and you realize it already because R&D, which you're part of, takes a long time to complete, and there is a lot of uncertainty whether the product will actually be successful in being receiving a regulatory approval, and then B, actually getting out into the market and being profitable, and who's going to pay you for the product, and all that fun stuff is going to determine if your ROI is going to be high or not. And so that's tricky. In the medical sciences, these calculations are going to be more difficult to manage and actually be less useful is maybe not the word, but you're not going to be able to rely on these easy, quick numbers you can calculate in other industries for return on investment. So financial modeling and your financial projections are always very important for you to do. And as I said just a few slides ago about your pitch, you're going to want to provide some projections, right, for your potential investors. So how can you do it? Well, there are definitely numerous tools which you can use to create your financial projections when you are modeling, of course. And this is basically what you want to do is predict revenues, right, in the future, and also predict future costs, because obviously that's where you're going to be able to get your predicted profitability over time. And this is, of course, going to help your investor understand the amount of money that's going to be needed for a given time period that they in order to make your startup profitable, you make your startup successful, make your startup grow. And that's what you want to be able to do, is provide them with that information so that they can estimate how much money they should give that's going to be useful, and or actually enabling, what's called enabling. So if they give you enough money, it's enabling for your startup to be to grow and be successful. So remember that when you're looking at your projections, it's not always just an increase that you're looking for, um, because these projections are important in all circumstances. And so here's an example of Pfizer's revenue with the big vaccine for COVID that came up. And so if you look on the left, the revenue for Q1, that is like total revenue, if you wish, total revenue for the company, you have 25.1 billion, 25.7 billion US dollars in Q1 of 2022, and then it drops to 18.3 in Q1 of 2023, and that makes sense, in the sense, if you remember, dealing with COVID-19, that the demand was going to drop, right? And because of that, your revenue drops. So you have a revenue loss of 29%. Wow, that's huge. So is that a problem? No, because I mean, Pfizer is still very profitable and made a lot of money. So that's not a problem. The question is, you need to forecast that. You need to be able to understand that that's coming, that there's going to be a drop in revenue. And if you look on the right, it's the revenue that excludes COVID-19 products, and you look, it's pretty stable, and there's actually a tiny little increase of 5% from Q1 of 2022 to Q1 of 2023. So this is the kind of information you want to share so that investors who are investing in your company are going to say, oh, well, is now a good time to invest in your company? Why are you asking me for money? And should I be jumping on board, right? And that's the reason you need to provide the financial modeling and projections. So how can we predict a company's finances? Well, it's very tricky, and financial projections are difficult and extremely sensitive to any assumptions you make, basically a priori, right, before your prediction. So whether you're looking at revenue growth, let's say customer acquisition cost, right, which is the cost to bring on new customers, market conditions, right, interest and tax rates. Well, a lot of the predictions you're going to make are going to be based on assumptions you're making now. And don't forget, these assumptions can change. And so that's why you need to be very careful when you make these assumptions and you provide your predictions. And just like in statistics, be very clear on the assumptions that were made. Always share those assumptions, because you may think that was the right assumptions to make. But people in the room, so investors and whatever, they may have a different take on what assumptions should be made in order to make those predictions. And very often, your investors are going to make much more conservative assumptions for predictions than you are. You're going to be, you drank the Kool-Aid, so you think, oh my God, this is all going to be amazing. And so you have to be careful about that. And so be very transparent about your assumptions, because it's very important for when you provide them, that people understand how the predictions were made, so what kind of modeling you used, and what assumptions you made. So that ends our brief introduction to the world of finance for startups in the medical sciences. There's way more, and I encourage you to read up on it and go to other sources to learn more about it. The next lecture is going to tackle a real tough one for people in the medical sciences or in healthcare, and that is the regulatory landscape. So not all companies are going to have to go through regulatory compliance for their product, but if you have anything to do with medicine, the chances are very good you will. If you do have to go through it, it doesn't mean you have to go through it immediately. So you're thinking, well, what do you mean? Well, sometimes you can have a product that can be, for instance, used as, as what's called a wellness product, as opposed to a medical device, or software as a medical device, or something that's used in healthcare that's going to be diagnostic or involved in treatment, which immediately involves regulatory compliance. If you work in the wellness industry, well, you're kind of easing into it because it is something that's digital health or related to health, but it is not diagnostic. It is not involved in treatment. And so then you kind of ease into it, and then you can convert your product. It's not even a conversion, it's just increasing your claims, right? So you start off by just saying it's helpful for keeping an eye on this, or helping you, give you more information on that, or educational, or a tracker or something like that. And then you start increasing the claims. So now if you use this product, we can share this information with your healthcare provider or something like that, and then they can use it to help better treat you and all that kind of stuff. And so then you're increasing the claim. And then once you do, then you tip into the world of regulatory compliance. So we'll talk about that in the next lecture. See you there.